Thanks for joining us today on Market Call. I'm Morella Fernandez. Brian Madden with us on the show, Chief Investment Officer at First Avenue Investment Counsel. He'll take your questions on North American Equities. Here's how to reach us today. Call us toll free at 1-855-326-6266. You can email your questions in as well. Market Call at bnnbloomberg.ca. Brian, good to see you.
Likewise. Thanks for having me, Morella.
Let's talk about tech stocks, which have been dragged down for a while now. A little bit of a recovery today. But do you see AI investor concerns as overblown?
No. So we would characterize what's going on, Morella, as kind of a tug of war between the dyed-in-the-wool, true believers, AI to infinity crowd, and some of the more recent pragmatics, or some would say skeptics, that are coming out of the woodwork. And so what that's doing is causing a bit of churn and rotation, almost akin to a tug of war of sector and style leadership in the marketplace. It's been very much an AI thematically driven rally ever since ChatGPT was born just over 3 years ago, but with fits and starts. And over the last 3 or 4 weeks, we're seeing one of these fits with a bit of a resurgence today, which we think the proximate cause of is Micron Technology reporting better than expected earnings after the close. And then, we got a little bit more rocket fuel to pour on the fire of the Santa Claus rally when the CPI numbers came in a little bit lower than expected in the U.S. So we've got a pretty strong tape out there today.
Okay, so because tech has been dragged down, I'm wondering if you are trimming at this point or readjusting the portfolio in light of that.
Well, to be very clear, Morella, we are very much fervent believers in the transformative potential of artificial intelligence. It's really, we think, a generational leap forward in technology. So we have been invested in it and remain invested in it throughout the value chain. So, that spans foundries that make semiconductor chips, chip designers, and adjacent or co-products like switches and routers. And then even upstream of that, of course, everyone now has heard, all they can stand of electricity and how power hungry these data centers are. So we're positioned there with merchant power producers in the United States. And then even upstream of that with natural gas and uranium producers, obviously those being feedstocks for electric power generation. We have sort of partially trimmed some of our exposures over the course of the last month or so, but only very, very lightly, and reinvested those proceeds into, let's call them, more mundane businesses, not the hyperscalers per se, but companies that are nevertheless taking advantage of and realizing major efficiency gains and opportunities as end users of some of these transformative technologies.
Do you find that you're seeing clear winners so far, those who are getting some value from implementing AI?
Yeah, absolutely. So I've got a couple of companies that we'll talk about in the last segment of the show that are sort of poster child for realizing commercial benefits from their use of AI, and they're not Johnny come lately on this either. They've been investing, in the case of one of them, for better part of a decade in some of these things, even prior to the advent of ChatGPT and large language models as we have come to know them today.
Okay. We'll take a quick break, then we will line up the first phone calls and emails for Brian Madden. He's of First Avenue Investment Counsel. Again, he's taking your questions on North American Equities. Here is the number to reach us and the email as well. Back in a moment. Welcome back. We will start right now with an email from Floyd. He says, could Brian please share his outlook for Saputo Exploration? Of course, this is a company that looks for natural gas and energy resources. Do you know them well?
Yeah, absolutely. I've owned them in the past, don't own them currently, but would have no qualms about taking a position in it, given a constructive view on natural gas. Our preferred exposure to natural gas producers would be Tourmaline, which I've spoken about previously on this show. Saputo is a somewhat smaller producer of natural gas. It's about a $4.5 billion market cap. Tourmaline is many multiples of that, north of $20 billion, if memory serves correctly. both operating in Alberta and, in the Western Canadian Sedimentary Basin, but targeting different parts of it, Tourmaline more so the Duvernay and the Montney, and Peyto more so the Deep Basin. Peyto is producing almost 90% natural gas, so it is a good, almost pure play exposure to nat gas as opposed to some oil, some gas, as you see with other producers out there. They produce about 130,000 barrels a day of oil equivalent, so you can convert that to natural gas. I won't do the math on the spot. And that production has grown at about a 4% compounded pace over the last decade. The company admittedly has had some ups and downs. It's enjoying an up now, but there were difficult times for Alberta and Western Canadian nat gas producers in the last decade, and so Peyto didn't sidestep that. They had a pretty generous distribution policy. They had to cut the dividend 3 times, in fact, in 2018, 19, and 20, cumulatively 95%. But incredibly, and under new management for the last 2 years, they've grown it all the way back to where it was in 2017. It's $1.32 a share. That's good for about a 5.9% dividend yield. So this is also a company that has done a good job, much like Tourmaline has, at keeping cash costs low, running lean. Part of the secret sauce there is owning their own processing plants and infrastructure. They own 17 of those. The other piece of the puzzle is diversifying their end markets away from the very low-priced AECO nat gas hub, and so they're selling at other endpoints and hedging very effectively. And so all that has sort of contributed to them being able to build the dividend back. There are catalysts on the horizon for the whole nat gas sector in Western Canada, notably the LNG export terminals, and there's more in the pipeline. The Major Projects Office is going to see that. And Peyto in particular is a partner in the Rockies LNG project that's on the drawing board. So although we don't own it, we like nat gas. I think this is a good company, well managed, and no quarrel with buying the shares here.
Okay, that was for Floyd. Let's go to our first caller. Elliot's on the line in Hamilton, Ontario. Hi, Elliot.
Good afternoon. Costco, 20% off its high. Multiple has compressed. Will the compression continue, or can the stem be tied, or tide be stemmed? Boy, what am I saying here? Anyway, your thoughts on the company and the stock, please.
Thanks very much.
Thank you for the question. Yeah, Costco has been off. I know they make a lot of money from membership fees, so they're going to continue to make money. What do you think about valuation for Costco?
Yeah, they make a lot of money from my wife and my mother-in-law primarily, but also about 80 million or so other members. We like the company. We like the stock. We own the stock. It's owned in our Momentum mandate, managed by my colleague Ian Chong. We like the visibility and the stickiness of that membership revenue. That also creates sort of a demand pull. People who have sunk a cost buying the membership, so they're quite loyal shoppers there, and they get a large share of wallet from their members. There's a pretty robust new store expansion story for a company that has been around for more than 4 decades. We're seeing them open in Canada, even in the U.S., where you'd think it might be saturated. It's not. And internationally, margins are good and stable. They're doing more and more in e-commerce. And the long and the short of it really is they basically invented the warehouse club model. They're the leader, the pioneer, and the 800-pound gorilla in the space, and it's proven resilient. Even to the likes of Amazon and other sort of electronic and online disruptors. It's experiential shopping in the eyes of some, not me, I should be clear to say, especially not on a weekend in December.
People really enjoy that whole experience of going to Costco and getting deals and sometimes trying the products.
Yeah, that's right, eating hot dogs, the poutine, all that. So, the knock against it, of course, perennially is that the multiple is high. It's always been expensive. You could have said that 5 years ago, 10 years ago, 15 years ago, 20 years ago. Any day that ends in Y is a good day to own Costco, and all the better with the recent pullback in the shares. So we like it long and strong, and good opportunity to enter if you don't own it.
Okay, let's move on to Ryan, who is on the line in Kingston, Ontario. Hi, Ryan.
Hi there. Questions on Canadian natural resources. Oil has been falling for about a year now, and it keeps making new lows. And this has me concerned. I know CNQ is a very strong company, but do you think there will be a better entry point for the stock, or would you still step in at this price? Thank you.
Okay, thank you for the question. A low the other day for West Texas Intermediate under $55 before coming back a little bit. Canadian Natural Resources sitting at $43.78. What are you doing with this side of the energy portfolio, the oil companies, which have been dragging down because of the price of oil?
Yeah, so we don't own Canadian Natural Resources. We don't own any sort of oil-focused Western Canadian producers. We do own a major integrated, an American one that's about 2/3 weighted to oil and 1/3 weighted to natural gas. But truth be told, we like the story for natural gas better than we do for oil. Oil has a lot of geopolitical influence on it. There's stuff going on with Venezuela. We don't know how that's going to end. And OPEC is, if anything, erratic and unpredictable. We don't know what a truce, and hopefully soon we get one in Russia and Ukraine, what that's going to do. So it's just not a commodity we really want to step in front of aggressively at this time. This is a good company. It's much better than it used to be. The balance sheet is significantly cleaned up, over the last 10 years. The assets are great, very long life, long reserve life, heavy oil and oil sands assets in Western Canada. Pretty good portfolio of natural gas production as well, and some international assets. These are going to be producing and cash flowing, paying dividends and funding share buybacks for a long time. But, we'd look for a better entry point, probably at a lower share price, and when the macro picture is a little bit more constructive for oil, frankly.
Okay. I'm going to take a first break here. We will be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American Equities. Back in a moment. Welcome back to Market Call. Let's go to Alfred. He is on the line. He's in Mountain View, California. Hi, Alfred.
Hi. Your thoughts on Berkshire Hathaway is off its highs from April around 540, and it's been trading sideways. So your thoughts on it, please. Thank you.
Okay, thank you for the question. Is this still concerned about Mr. Buffett stepping down?
No, we don't think so, Marella. That obviously at his age, it was not a tremendous shock that, his time was going to be coming to an end. And of course, he'd been grooming his successor for a long time. I think the market is quite comfortable that he's chosen an excellent replacement. And more to the point, he's sort of set up governance and culture within the organization that will support his principles being practiced for a very, very, very long time to come, if not, outright in perpetuity. So what you have here is, essentially, like a mutual fund or a conglomerate trading in a public company, Shell. It's a great collection of businesses spanning, industrials and transports, and some of the cornerstones would be things like Geico, the insurance company, and the list goes on and on. But all of them have that hallmark of quality and sustainable, durable, competitive advantage, structural profitability that's proven very, very enduring. And that was really part of the magic of Buffettology and Munger as well, frankly. So that portfolio is intact, and the Buffett's successor has big shoes to fill. And a lot of dry powder to deploy. And this is another hallmark of Berkshire Hathaway. They like to be liquid so that they can write the big checks when the big opportunities come in the market. And so some of their best deals are struck when there's blood in the streets. You can think about, writing that those 9% preferred shares to Goldman Sachs and things like that were done in the darkest days of the financial crisis. And those, of course, have paid off very, very handsomely. So Berkshire, I think, customarily will tend to lag equity indices when they're in frothy, rip-roaring bull markets. And there's no doubt we've been in one of those this year and really in earnest for the last 3 years. So it's not surprising to see that this is not at all-time highs, but that's what creates and sets up a good entry point. We don't own this ourselves. We would prefer to buy individual stocks and build our own portfolio. but certainly can put our stamp of approval on everything that Buffett and his team have put inside of Berkshire Hathaway over decades.
So do you worry at all about it trending further down? Do you feel like it could regain? A lot of people have been watching it come down this year and wonder what the future is for Berkshire.
Berkshire's future is, indelibly intertwined with the future of America. And, what we know is the American economy is the most dynamic in the world. It grows inexorably. Shareholders own the profits in the economy, so those profits grow inexorably. And Berkshire Hathaway has hand-curated a portfolio of some of the best businesses in America. So these shares will continue to make successively higher and higher all-time highs for a very long time to come, we think.
Okay. Let's get to an email then from Hillary. Hillary says, good morning. Could I have Brian's opinion on Saputo, please? Should I continue to hold or take a small profit and sell as the dividend is quite low? Thank you. We'll have a look at Saputo, which has done pretty well this year, last time I checked. But what's your take on whether now is a good time to sell?
Yeah, we think now is a good time to sell. We don't like Saputo. We don't own Saputo. Haven't owned it for probably a decade. And in the portfolios I've managed, the re-rating is a blessing. What you have here, this company went public, I believe, in 1997 or 1998. And for nearly 2 decades, it grew very steadily. Not surprisingly, it produces, a staple product, cheese. It's got a large, I wouldn't say outright dominant, but certainly, a scale position in that market in North America and other markets. But then the law of large numbers started to catch up to them. Organic growth, not surprisingly, in the consumer staple category started to slow. They started to make acquisitions. And those acquisitions diluted the overall quality of the business that they've now put together. Structurally put margins on a long downward path, suppressing what used to be a strong and robust return on shareholders' equity. So it's just not as good a business as it was, let's say, pre-2015 or 2016. And then finally, the elephant in the room, the dairy and supply managed sectors in Canada are very much in the crosshairs for negotiation. And they seem to be a personal sore point with the President of the United States. So as much as supply management and milk and dairy and such, poultry has been, pardon the pun, a sacred cow in previous rounds of trade negotiations. I think everything has to be on the table here. And so we just don't know what that would look like for Saputo. And it might take a company that's sort of been diluting its margins of its own accord for a decade and put it on an even weaker footing. So the bounce is a good time to lighten up or sell outright, we think.
Okay, let's get to another email from Sandy, who says, can I have your comment on CSU, so Constellation Software? Why has the stock price dropped this year, and is this a good time to buy? You see this often where there's a bit of a shock in the news for a company, and then it doesn't really recover. And Constellation Software seems to be in the same position where they announced that their leader is stepping aside for health reasons, and then things just started to slide, and it hasn't come back up. What do you think about Constellation Software? Should you pick it up at this point? Would you hold it if you already own it?
You should pick it up. If you own it as we do, you should continue to own it or even consider adding to it. So first of all, let's take a step back and understand, how did we get here? So you cited, Morella, one of the factors. So Mark Leonard, who's the founder and a longstanding CEO, for health reasons, announced he was stepping down a few months back. Investors weren't expecting that, and it was a bit unsettling in perhaps a similar way that some might have had consternation about Buffer's succession plans at Berkshire, as we talked about earlier. But this was different because it was unexpected. And of course, Mark Leonard is not young, but much younger than Buffett. So, there were concerns about that. Beyond that, and more to the fundamentals, this is a company that, although the name says software, it's part of the technology index. Really, we see it as sort of a software-focused private equity fund masquerading as a publicly traded software company, because that's really what it is. This is a serial acquirer and consolidator of the very fragmented vertical market software space. They buy small operators, bring them under the umbrella of Constellation Software, but largely let them run autonomously. However, they do equip them with operating principles and some shared services and scale advantages. And there's a lot of wood to chop in this opportunity set. There's literally thousands and thousands and thousands of these vertical market software companies worldwide. They're mission critical in the narrow niches that they serve. They have recurring revenues in many instances. So they're sort of like cash cows that you can milk. And Constellation's got a deep pipeline of potential deals to get after. And then finally, the other knock against it is it's a concern that some investors have that vertical market software is a sector that is very apt to be disrupted by some of the big AI that's being developed by larger software companies. We don't really buy that argument. The company, in a rare move for them, did an outreach to investors to talk about some of the AI initiatives they're working on. But long story short, this has been a company that's been public for almost 20 years. I think it's been the best performing company on the TSX since it went public. And that's not for nothing. So when you see dips in a serial grower and compounder like this, you buy them.
Okay, we're going to take another quick break. When we come back, we'll have a look at Brian's past picks. That's next. Welcome back. Time now for a look at Brian's past picks from December 4th, 2024, so over a year ago. First up was TELUS, T on the TSX, 2207 out the time, so a year ago. 1748 now, so a return drop of 21%, a total return drop of 11%. The difference being the dividend here, and of course the dividend has been in the spotlight for TELUS more recently. Do you see TELUS sort of coming back from the dividend announcement?
Yeah, we do. So, this one, when you have something like this, it is obviously a bit of a glaring outlier. You've had a strong market. So first, let's recognize it's not in the leadership part of the market. It's slow, it's dodgy, low organic growth. But it is a stable and consistent dividend grower. What has sort of set it back recently is, they've taken a hard look at their balance sheet and their organic growth prospects, the competitive intensity in their core business, telecom, and they've basically ratcheted down their aspiration for dividend growth. They had previously been aspiring to grow the dividend at 3 to 5%, compounded over many years, and they've said, we're going to put a pause on that. I think what they really don't want, and what no company wants, is to suffer the fate that their rival did earlier this year. That's BCE having to cut its dividend 50 or 60%. That's not a good outcome. So I think they've prudently said, all right, let's pause the hikes, let's get our payout ratio more in line, and let's delever the balance sheet a bit. And the market's disenchanted with that. So, we have to take a hard look and say, were we wrong or were we early? Mea culpa, perhaps a bit of both. We thought they'd be able to continue growing the dividend. We still think the shares are undervalued. We like some of the unpriced catalysts, like the surplus real estate in urban areas that used to be switching centers. They're going to repurpose into high-density multi-res housing, which Canada desperately needs. They're also going to decommission all the copper because you don't switch phone calls on copper wire anymore. It's all fiber. I think there's $1 billion of copper for salvage there. That's a lot of copper, and we know the world needs copper. And then beyond that, they've diversified into some higher growth areas away from the core telco business, which is admittedly fairly mature. So that's TELUS Health and TELUS Ventures. They acquired Morno Sabeco, which is group benefits and pension consulting, wellness, that sort of thing, e-health, and there's TELUS Agriculture. And so those are going to drive, structurally faster organic growth than their rivals. So we think these shares will re-rate higher, and they didn't this year. So we're going to be patient with this one, but concede it was the disappointing performer year to date.
Okay, let's get to your next past pick from last December. Microsoft MSFT on the NASDAQ, 437.42 US at the time, and now to 481.84, so 10% upside, 11% total return. Have you trimmed with Microsoft? Are you hanging on to sort of the majority of what you have?
Yeah, over the years, we've owned it for a long time. We have, sort of traded it tactically, trimmed it up, trimmed it down, but it's a good core weighting in both of our two equity mandates. So our dividend growers portfolio, this is not a huge dividend yield, but it is committed to growing the dividend, certainly more than capable of doing that. notwithstanding the fact that they're spending a lot of money to build data centers and cloud compute capability. And it is also owned in our momentum mandate, which tends to own dominant leaders with very dynamic growth. And Microsoft definitely checks that box. And the biggest driver, certainly the thing the market is most focused on, is their cloud computing business, Asia in particular. But beyond that, they've got more personal computing, and they've got the ubiquitous, Windows and Office solutions, which are not nice to have, but need to have. They're mission critical, whether you're a business or a household. They've been dominant in that space for decades, and we think that competitive position is well entrenched. And then moreover, they're on the forefront of the AI revolution, interests in OpenAI and other initiatives on their own. So, we continue to own it, and the pullback is a good opportunity for those who don't own it to get invested, we think.
Okay, let's get to your third pick from last year, Allied Properties REIT, AP.UN. On the TSX, 1842 at the time, and now at 1309, so 29% downside, a 19% total return downside. REITs have been struggling. Do you see a comeback in the space, first of all, and have you held on to Allied Properties?
So we have held on to this one, and this one, has committed the cardinal sin of dividend investing. And so, I think during my tenure with the firm and leading our dividend growers mandate, we've only had one company cut their dividend, and this was the one. We knew this was a risk. We invested in this, about 5 quarters ago. It had a very high yield, 9.5% or something like that. And we kicked the tires pretty good, met with the management team towards some of the assets, the properties, that is, which are primarily office, but with a sprinkling of retail in the mix as well, mostly in core urban areas in Toronto and Montreal, with a bit in Vancouver, Calgary, Edmonton, and Kitchener-Waterloo. And so we saw an office recovery on the come. There were initiatives from the provincial government driving a return to office mandate. The banks have all done that. And they have very desirable and distinctive properties. And so we saw occupancy moving higher. That's been slow to come. We thought they would sort of stretch their leverage metrics and sort of test the limits of the credit rating agencies and continue paying their distribution. But it sounds like their board of trustees, proactively cut the distribution to sort of reset the financial sustainability while we wait for occupancy to improve. And we think that it will. In fact, we're all but convinced that it will, because people, knowledge industry workers who they largely lease to, are more productive when they work together in an office. Question is how long, and they've bought themselves some time by reducing the distribution to delever their balance sheet, to divest of non-core properties, and that's well underway, and eventually reset this distribution on a more sustainable growth trajectory. So we saw all along an undervaluation, and with a paid-to-wait opportunity, swing and a miss on the paid-to-wait, the undervaluation remains and is bigger than ever. So we see an even more compelling total return potential in these shares now than we did a year ago when we first talked about them.
Okay, good to know about Allied Properties. We're going to take a break. Back with phone calls for Brian Madden, First Avenue Investment Counsel. Again, he's taking your questions on North American Equities. We're back in a moment. Welcome back. Let's get to Ben on the phone line. He has a question today for Brian. Hi, Ben.
Hi. Thank you for accepting my call. Brian, I have a question about Manulife. I bought it on March 2022 at 25.26, and now it's about 50. So I was wondering if I have a small position in my TFSA, and I was wondering if you see this stock going to about like where Sun Life is now, about the high 70s, low 80s, the next 4 years, and you own it. Thank you.
Thank you for the question. So Manulife, we will pull up here. Do you guys invest in sort of the insurance space?
We do. We don't own Manulife, and we don't own any of the life codes. We've had a number of investments and have a number of investments in the property and casualty sector. Life insurance sort of struggled. Manulife in particular struggled for quite a time. It was range bound between about $20 and $30, and then it sort of broke out of that range about a year and a half ago. thanks to some very purposeful strategic repositioning of the business undertaken by the previous CEO, Roy Gori. So for those who don't know, there's obviously the big Canadian business, there's a US business, there's a wealth and asset management business, and then there's an Asian business where they've been for over 100 years actually in some of those countries. Big growth drivers traditionally have been wealth and asset management. Those are fee-based businesses and just have secularly better growth prospects and better opportunities to wield scale advantage. And then, of course, Asia has been a faster secular grower just given the more rapid growth of the population, and in particular the middle class population there, where protection, so life insurance and accumulation or investment products become more of an addressable market opportunity for them. And what was always holding them back, Canada was fine, it chugged along and grew slowly, but the US business had gotten big into things like variable annuities and long-term care insurance, and that was creating a lot of headwinds for them. So they've unwound a lot of that exposures. They've also taken some complexity out of the balance sheet and de-emphasized some of these illiquid assets that they had on their books. And it's all sort of driven pretty robust and dynamic earnings per share growth that was previously kind of elusive, and the stock had always traded at a low multiple and had a high yield, and it's really re-rated higher. So we think the step function re-rating is probably largely played out. It's trading at a premium to the banks now of probably 1 multiple point or thereabouts. They used to trade at a discount. But to the extent that they can continue growing their earnings, at a good pace, high single digit, low double digit, you put that together with the dividend yield, which is I think about 3 point something % or thereabouts, you have a pretty good algorithm to a visible double-digit total shareholder return. So we'd continue to hold this one, although, if in your case, we don't own it ourselves because we've placed our bets elsewhere, notably in property and casualty insurance.
Okay, that was for Ben. Let's go to Walter in Ottawa with a question. Hi, Walter. Walter, are you there? Okay, we may have lost him. Let's go to Kevin in Mississauga, Ontario. Hi, Kevin.
Hi there. Season greetings to both of you. My question was about Laurentian Bank. I'd love to hear Brian's thesis on it, whether he would perhaps get in now for a potential upside because it is still below book value. And if not, if he held it, would he get out now?
Okay.
Please and thanks. Happy holidays to all of you.
Thank you for the question. I'm looking at the chart. Does that straight line up? I guess when they announced that they're selling, sort of dividing up assets and selling, today sitting at $40 flat. What are your thoughts about whether this was a good deal for Laurentian Bank and what it means for the company?
Yeah, thank you for the question, Kevin, and season's greetings to you as well. We don't own Laurentian Bank, and not to mince words, prior to this transaction that Marilla referred to, wouldn't have touched it with the proverbial 10-foot pole. This deal is and was and will be the only deal for Laurentian. This is the end of the line for this company, which has lived for a long time, but it's been fading into obscurity and irrelevance for decades. Banking is increasingly a technology-enabled and scale advantage game. Laurentian didn't have the scale and never really built the scope, didn't diversify enough away from spread or net interest income into fee-based businesses like wealth and asset management and capital markets and insurance and so on and so forth. So effectively what's happening is it's being carved up and yard saled, and it will cease to exist as a public company. National Bank, kudos to them. They're getting the branch banking business, the traditional deposit and lending, which is largely a Quebec-based business, for very, very limited, negligible almost consideration. I don't think the exact terms were disclosed. That will be synergistic and accretive for them. There is a sad postscript to this in that they're closing all the branches, and there's no assurance that any of the thousands of employees in Quebec will be offered continuing roles with National. That's unfortunate, but for shareholders of the National Bank, they struck a good deal. And the rest of the business, which is a specialty lending book, is being acquired by, I believe it's Fairstone Bank. We don't think there's going to be a competing bid here. And the reason we say that is because this company, under a former CEO, threw open an auction process about 2 years ago. Everyone came, kicked the tires, and said, thanks, but no thanks. So c'est la vie, and end of the line for Laurentian. So yes, we would sell.
Okay. Let's go to Walter. He's back on the line. He is calling today from Ottawa. Hi, Walter.
Hi there, Brian. Thank you for taking my call. I know you had been bullish on TD Bank several months ago when it was much lower, and I took your advice. Excellent call. Thank you. Now it's run up to about 127 and change. Its PE, I think, is around 10. Would you still be adding at this price? Thank you.
Okay, thank you for the question. Would you add at this point? Would you trim? What would you do?
So, yeah, thank you for the question, Walter, and your kind words. Glad it worked out for you. It's worked out for us as well. We still own this. We added to it in early December last year when they ripped off the Band-Aid and agreed to that $3+ billion settlement with all the U.S. regulators for their woes and troubles down there, and I use that term euphemistically. They've got a lot of work in front of them to clean that up, but under the new CEO, they're doing that. I attended their investor day in September, got more clarity on what they're going to try to do to reset their growth algorithm to grow at a high single-digit pace. It's credible. Their progress towards it 1 year in under the new CEO, Ray Chun, is impressive, and the market's recognizing that. We did trim this, not that long ago, so it's now the smallest weighted among the 3 Canadian banks that we own. But we think it's a great bank. We think it's one of the 3 best banks in Canada, and we think it should form a core part of a well-diversified North American portfolio, and particularly one that's got a dividend growth bent to it, as our dividend growers mandate does. So we continue to own this, although we think the step function re-rating and the degree to which it's left the other big 6 bank peers in the dust in terms of stock market performance this year is unlikely to be repeated in 2026. But again, as with all the banks, and much like what I said about Manulife, you take the sum of the dividend yield plus, if you believe the plan, the aspirational growth rate of dividends, which in their case is high single digits, you add them together, and that's what you should expect over a cycle for total shareholder return. So we look at that, we do that math. We see a good line of sight to a low double-digit total shareholder return, which should, over time, it has over time, outperform the TSX. So we continue to believe that and still hold a core weighting in this name in our dividend growers mandate.
Okay, let's leave it there for now. We'll be back in a moment with more questions for Brian Madden. Stay tuned. Welcome back. Let's go to Sal on the line in Vancouver. He has a question. Hi, Sal.
Hi there. Yeah, my question's on next by its price movement, given that next year there's the whole region.
Okay, so Sal, you're cutting out, so I'm going to leave it there. But I know he had a question about Bombardier, which has had made several announcements. The Royal Canadian Air Force announcing a purchase, and they've been paying down debt. So let's do a forward look on Bombardier.
Yeah, thank you for the question, Sal, and apologies if there was some nuance to it that we didn't quite catch with the audio there. But high-level thoughts on Bombardier. We own this stock in our Momentum mandate. We dusted off the file. This basically was uninvestable for 20 years. People with a long memory have been in the business a long time. Will remember this was a market darling from 1990 through the turn of the century. Just a massive grower, and that was on the strength of their commercial aerospace business. That faltered, and they basically have simplified what was a complex multi-divisional company with trains and transportation, commercial aerospace, and at one time Sea-Doos and jet skis, down to a pure play on private aviation. But I should say almost a pure play because, as you noted, there is a bit of a military side business there. And so it has become a much better business. It is dominant. We think it is market leading in terms of the capability of these aircraft, which are sold, to be clear, to the 1% of the 1% of the 1%. These are the Challenger and the Global Express series of medium and long-range jets. They're best of breed. They're one generation ahead of their big competitors, Gulfstream notably. And the other one whose name escapes me in terms of what these planes can do, fuel efficiency, range, speed, comfort, amenities, they're excellent. They're also building a good aftermarket parts and service business that creates not exactly recurring revenues, but a predictable stream of post-sale cash flows as you need to maintain and service and replace worn-out parts to keep these aircraft in the air. We do a lot of business with the fractional fleet operators, your NetJets, FlexJets, and so on. And then the story has sort of taken on a new dimension in recent years. They've got a small, but we think what's going to be a bigger business selling some of these planes to NATO allies. They repurpose them for command and control and reconnaissance planes. So lots of ways to win here, and we don't think enough investors have dusted off the file and taken a fresh look at this. We have, and continue to like and own it here.
Okay, Sal, I hope that worked for you. We do have to take another quick break. We will have new top picks from Brian Madden when we come back. And join us tomorrow on Market Call. David Burrows on the show. He's President and Chief Investment Strategist at Barometer Capital Management. He'll take your questions on North American large caps. That's tomorrow. Time now for new top picks from Brian Madden. We begin with Trican Well Service, TCW, on the TSX. They do, as in the name, provide well services. What do you like about this company?
Yeah, so this one, taking a bit of a step back, many of the companies we own and talk about are household names or better known. This is a fairly small company, but nevertheless, it is Canada's leading pressure pumper, fracking, and well completions company. They also do coiled tubing, cementing, and acidizing wells. So that's the initial sort of well completion, and then servicing and cleaning out wells as operators need to do from time to time. The company has had its ups and downs over different cycles. At one time, it traded at $27 a share in 2011 when oil prices were high, fell to 50 cents in 2020. Now it's trading just under $6. They swapped out the CEO and have brought in new management since 2020. They're doing a good job. They have structurally improved their margins and the returns on invested capital, and that's largely through investing in high-spec advanced fleet. That means low emission and high horsepower rigs. It's been buying back its shares prolifically. We applaud that because the shares are very inexpensive, trading at under 10 times earnings, below 5 times enterprise value at EBITDA. Cumulatively, since 2017, it's retired 47% of its outstanding shares, which is quite a formidable accomplishment. 2 years ago, it reinstated its dividend. It's grown it, at a compound pace that's compelling. It yields about 3.9% now. And what was the catalyst to get us interested in this name was its very synergistic and accretive acquisition of a private company called Iron Horse Energy in July. But we bided our time. We introduced this to our dividend growers mandate in November at around $5.70 or so a share. And so we see a pretty good potential for both growing stream of income and meaningful capital appreciation here with major leverage to recovery and activity, particularly in natural gas in Western Canada, where it's the leader in the prolific Montney and Duvernay basins.
Okay, let's get to your next pick, McKesson MCK on the New York Stock Exchange. They distribute drugs essentially in the U.S., and I think they have quite a large business there.
They do. I think it's $400 billion a year in revenue or thereabouts. It's very high on the Fortune 500. It's the largest player in the space. And it is an oligopoly, a de facto oligopoly, with the top 3 players having a combined 90% market share. So in a nutshell, what they do, they're a distributor. They procure and source and transport and store branded and generic pharmaceuticals from the pharma companies. They move them to their warehouses and logistics hubs and then on to pharmacies and hospitals, long-term care homes, and other primary care endpoints. It's a company that serves a need and not a want. Obviously, prescription drugs they're not discretionary, secularly advantaged by demographics and morbidity trends in the United States. It's cleaned up its organization, divested things that were a drag on profitability, like Rexall here in Canada last year, some of the smallish European businesses. And they've also identified a catalyst to surface hidden value. They're going to be spinning off via an IPO their medical surgical products unit, which is smaller but growing faster and has higher margins than the big drug distribution business. So although the stock has done very, very well in the 2 years we've owned it, we see meaningfully more upside still in the tank here.
Okay. Let's get to your last pick, which is Intact Financial. I've got about a minute left. IFC on the TSX. What do you like about Intact in this space?
So this one, of course, much more of a household name. It's the largest property and casualty insurer in Canada. They write auto and home and commercial and specialty insurance policies. Very lean operator. They target, combined ratios, which is their core underwriting profitability that's superior to peers. They almost always achieve it. They target a return on shareholders' equity that's 500 basis points above their peers. They almost always achieve it right now. Their return on equity is about 20%. They're a consolidator of this fragmented space, buying smaller insurance companies and then leveraging scale advantages. They've acquired their way into larger and faster growing markets via platform acquisitions in the US, UK, and Ireland. So good path to a high single digit or low double digit total shareholder return in these shares, especially with the pullback.
Got it. All right. Intact Financial, the last pick from Brian Madden. Thanks for coming in. Happy holidays to you.
And same to you and to all the viewers. Thank you, Marilla.
All right. And thanks for joining us today on Market Call. We'll see you back here again tomorrow.